the international headlines on tariffs. So let's actually address that good news. Like we've been telling you, February CPI inflation has come in 3.61%, which is a lot lower than the poll. Our CNBC-TV18 poll was 3.85%. And the January IIP data has come in higher than expectations at about 5%. We have Latha joining in to dive a little deeper into all the goodness. Latha, good morning.
Well, what is good about the inflation numbers is that for 2 months in a row, we are coming in lower than expected. While this month, February, it is 3.6 compared to 3.85 expectation. In January as well, the expectation was 4.5. It came at 4.26. Likewise, food inflation, which has been the bugbear, up until December, for the previous 18 months, inflation was running between 8 and 11%. January, it fell to 6, from that 8% levels. And now the expectation was 4%, and we get 3.75. So there is something systemic or structural, one feels, about the way in which inflation is consistently coming lower than expectation. Now, of course, CPI is headline is at 7-month low, but food inflation is at multi-year. It's like some 3-year low. And the only two elements that are really worrying in the entire food basket are fruit, which is about 14%, and edible oils, which are higher because tariffs were raised on them. Otherwise, all other major food items, cereals, pulses, milk, meat, eggs, just about everything, and vegetables are in low single digit or even negative in some cases. So that does look like there is something structural about this food inflation falling. Only core inflation has gone up by 30 basis from 3.7 to 4%, but that's largely because of gold and not because of metals or something which will work its way into higher prices. So the consensus among economists, they've all moved to now 3 rate cuts. 1 already done, 2 more to come. Until now, there were people who believed that there'll be only 2 cuts. So clearly now 5.75 is the repo rate that people are talking about. And one more thing. By the time we come to May, already the Reserve Bank is giving a lot of liquidity. By the time we come to May, there is a huge 2.5 lakh to 3 lakh crore dividend that will come from the Reserve Bank. So, we can guess whether the stance will change. Why would you keep it neutral? It is accommodative when there's so much liquidity. So maybe in April, you will also get a stance change. Things are very cheerful in the bond market. And now, of course, let's come to the growth numbers. As you all have pointed out, the IIP coming in at 5 is so much higher than the 3.5%, which our poll threw up. But much more than that, compare this 5 to the April-January number. That is 4.2, average of the last 8 months. So, last 10 months. So that itself shows that there seems to be a systemic jump. And of course, within that, manufacturing 5.5, again, April-January average is 4.2. So is this a systemic shift? Is this a structural shift? Is, a hint, that is a question that we can ask ourselves. Capital goods, infrastructure, consumer durables, all of them are 7% or higher than 7% within the manufacturing basket. So this is a great set of numbers. It's only consumer non-durables which has contracted. That's a spot of bother. So all told, there is reason to believe that the good cheer may continue unless, of course, global headwinds are too much.
Right, Latha, thank you so much for that. You bring us double delight out here, lower than expected inflation, better than expected growth.